Recipes for technical trading success in Cook's Kitchen.
Welcome to Cook's Kitchen. I know it looks a little bit like Cook's Library today, but that's because our topic is a little bit academic. I'm going to try and make it more practical, though, and we'll do several videos in this series. Behavioral Economics 101. Let's get right down to it. I say your brain wasn't made to trade. I'll explain that in a moment. Let's go to the official definition of behavioral economics. Along with the related subfield, behavioral finance, it studies the effects of psychological, social, cognitive, and emotional factors on the economic decisions of individuals and institutions, and the consequences for market prices, returns, and resource allocation of the impact of different kinds of behavior. So that's the long-winded definition from Wikipedia. I'm trying to pack a lot in there, but there's a lot to study. I have studied this for a long time as it affects not just investing or short-term trading in, say, the futures markets or options, but also everyday decisions. Here's my shorter definition of what we're talking about. People are far less rational than they believe they are when making decisions about money, uncertainty, and risk. So that's the way I sum it up. It's really, I would go so far as to say, hey, we are fundamentally irrational, especially when it comes to money, uncertainty, and risk. And that first definition from Wikipedia even left out the words risk and uncertainty, which is really what it's all about. You know, you have to make decisions about the future, whether you're investing, buying a home, getting married, going to school, whatever. There's always uncertainty and there's always risk. There's always trade-offs. All right. So in the field of behavioral finance, behavioral economics, the psychologists talk about cognitive biases and heuristics. Heuristics are mental shortcuts or rules of thumb. Here's a whole list of them: anchoring, overconfidence, confirmation bias, gambler's fallacy, framing, loss aversion, regret. These are the things that psychologists, have given names to because they've seen this behavior pop up over and over again. Why did somebody make that decision? Why do they feel that way about a past decision or a future one? And this is fascinating stuff once you get into it. We'll spend some time in the future defining several of these. If you look at a long list of cognitive biases or heuristics, there's probably 40 or 50 meaningful ones. But even if you just look at a dozen of them, you can gain some knowledge and get some use out of them. And that's really the point. Is if I say that your brain wasn't made to trade, I want to teach you how can you train your brain. You train your brain to become a better trader or investor, and how also can you play the market? Because if the crowd is acting basically irrational, smart investors should be able to take advantage of that, and I'll show you some. All right, moving along. Taking a little bit of a step back, who's studied this before? That book on your left, Extraordinary Popular Delusions and the Madness of Crowds, that book was originally published in 1841. Charles Mackay, I don't know if he was, I believe he was Scottish, yes. He was looking at all kinds of manias that were going on, whether it was people believing in alchemy or horoscopes or any of that kind of stuff, but also economic manias too. Tulip bulb manias, that kind of thing. And then Kindleberger wrote the book Manias, Panics, and Crashes. I believe this was only published 20 or 30 years ago. But this is some background on how the crowd acts and then how individuals act. All right, so now here's the guys that really got behavioral economics and behavioral finance into the textbooks, so to speak. Daniel Kahneman and Amos Tversky. And I emphasize that these guys practice the scientific psychology. So they were psychologists, but they weren't giving counseling or talking to people on the couch. They were taking psychology and doing hardcore research. So they set up all kinds of studies so we have this field where there's dozens and dozens of cognitive biases. They discovered and identified them with certain tests that they would give people, and they're repeatable tests, and many of them are fascinating. One of the biases I didn't list was mental accounting, and I'll give you an example of that one. Let's say you're headed to the theater, you're going to see a play or a concert or something, and you've already bought your tickets. You have your tickets with you, you believe. They cost you $40. And you get to the venue and realize you don't have your tickets or you've lost them. So the question put to people was, you have money with you. Are you going to spend another $40 on tickets? Over 80% of people say no. Okay. Those same people are asked a similar question with a different frame. And the question is, you're going to the venue, you're going to the concert, theater, whatever. You don't have tickets. You brought money to buy them. And you open your wallet or purse, and the money you had set aside, $40 for those tickets, is gone. So you either lost the money, misplaced it, whatever. And then the people are asked, do you take extra money that you have and now buy the tickets? And over almost 60% of people say, yeah, they would. Well, those two problems are exactly the same in terms of the exchange of money and value, but people view them differently. So that's why you get 90% of people saying, no, I'm not going to shell out more money for tickets that I lost. So they have compartmentalized that accounting in one place in their brain. But if they just can't find the money they were going to use for tickets, they'll go ahead and buy some anyway. Completely different decisions for the same problem. So that's an example of how people can be basically irrational when it comes to money and risk. All right, so here was the article I wrote in 2008, something I've been working on for a few years. I published it in SFO magazine. The actual article title was The Mental Models of Financial Sabotage, but my thesis was your brain wasn't made to trade. And I was taking what I learned from the trading floors in Chicago at CME and reading Daniel Kahneman and the behavioral finance guys, and also reading about brain scientists, and said, the scientists are learning what good traders learned the hard way. So on the trading floor, on a trading desk, you see good traders that survive for a long time, and they've learned certain things. They didn't learn it by reading a book about behavioral finance. They learned their own psychology and the psychology of the market, and they applied it. Well, the behavioral finance guys and the neuroscience guys and gals were discovering what great traders knew. So that was my thesis. Your brain wasn't made to trade, so you had to train your brain. And in my article, I highlighted, rogue traders, guys who took down, Nick Leeson took down Barings Bank, one of the oldest, actually the oldest bank at the time, from 1762, Barings Bank a British bank had been in existence, and he took it down trading Nikkei futures and hiding his losses till they amounted to enough to take down the whole bank. So I looked at rogues and gamblers and the market wizards, and I found that it wasn't just greed that was driving them. The other three things that drive people to act extremely irrational with money and risk, whether it's their money or someone else's, is number one, ego, the desire to be seen as a great trader. Two, just fundamentally irrational and unconscious beliefs about money and self-worth and happiness. And three, ignorance or lack of skill with probability. We'll come back to the probability one, but after I wrote this article, when I wrote it, I said, this stuff will happen again. There will always be rogues doing this. There will always be people finding a way to lose $1 billion of somebody else's money. And shortly thereafter, we found out about Bernie Madoff. And what he did, trying to be the great trader, hiding the losses, creating a Ponzi scheme, and paying people off, and basically destroying the wealth of dozens, if not hundreds of people. And so how irrational was that? Well, he's paying for it now, but he can never repay those people. But this stuff will continue to happen no matter what kind of controls you have in place. Incidentally, the place where I published that magazine article, SFO, that magazine is now defunct because the publisher was running his own Ponzi scheme. And he may or may not be in jail, I'm not sure. All right, so the probability thing was really important because when I read these books, the Market Wizard books by Jack Schwager, I found 6 universal themes that all the market wizards had in common: psychology, risk control, discipline, probability, systems thinking, and actual systems, and consistency. Now, who are the market wizards? You're talking about George Soros, Monroe Trout, Paul Tudor Jones, some of the great traders that were on the floor in Chicago, in offices in New York, and really carved out a niche for themselves in the 70s, 80s, and 90s, and created billion-dollar fortunes. So these themes that they had in common are extremely important. The probability one stood out to me that a lot of people who get in trouble with money don't have a fundamental grasp of probability mechanics to override their natural decision-making biases. All right, so this was my quote in my article. Without these, we are like a rogue trader, and what the rogue does to $1 billion of other people's money, we do to our own accounts. So that's why it's good to look at this stuff, because you can see how people destroy their own small trading accounts or larger chunks of their long-term portfolios by not examining their own decision-making. All right, next. So for more background, you want to be familiar with some of the literature here, like Peter Bernstein's Against the Gods, The Remarkable Story of Risk. Just an excellent book. And he explains how did we discover probability, in the 1650s. Pascal and Fermat basically created the foundations for probability, and then what that became. It became modern portfolio theory, and created the options market, the Black-Scholes option pricing model, all this rational stuff that we could do with probability, and then some people started concluding that the markets were really rational because all this would work out in the end. The idea is, are the markets rational? Well, here's a quote from somebody. I'd be a bum with a tin cup if the markets were efficient. And that's actually Warren Buffett saying that. So, and he's admitting, hey, we make money because people are irrational, and the markets as a whole can be irrational, not efficient. So, so that's where the opportunity lies. All right, I should also mention Nassim Taleb, Fooled by Randomness from 2001, where he noticed that traders, even from big bank desks, were irrational. So not just the rogues, but even people's idea of, somebody made a great trade, they made a bunch of money, and then not viewing that as, well, that's just the survivor that you're seeing. Maybe there wasn't as much skill as luck as you see there. So, being fooled by randomness is much more common than we think in everyday life. And then Taleb, of course, wrote The Black Swan, where he goes into more detail about, using those a Black-Scholes type model, an efficient market model, modern portfolio theory, to assess market risk. Okay. Previewing my podcast, which begins shortly, Mind Over Money, where we're going to be talking about all this stuff, and I'll have some good guests on too. Before I go, I want to make sure I give credit where credit is due to other people who've written excellent books on all these topics. Mean Markets and Lizard Brains. This is by Terry Burnham, and Burnham he's a behavioral scientist. I think he's also was trained in the life sciences, so he might even call himself a biological economist for all I know. But he actually worked for a major hedge fund for a short time. He doesn't any longer, but that trend will only keep going. Hedge funds are employing behavioral scientists and cognitive people because they just don't want somebody programming the next algo. They also want to know what human behavior are we trying to take advantage of here. Next up, Jason Zweig. He's been writing for the financial publications, Money Magazine, possibly the Journal, I think. And this is an excellent book. He published this in 2007, and he was already, I didn't know this at the time when I was looking at, let's look at the brain science and what the behavioral guys say. He was already doing that too. And so he brings it together, and he's really trying to help people, hey, when you approach the markets, make sure this is what brains tend to do. And the place we get all this knowledge about, from the inside out, from our brains, is is the imaging that that brain scientists are doing to be able to watch your brain, our brains, and see how decisions and behavior are happening, at the neural level and in different parts of our brain. So, those are really the two ways of looking at this. The behavioral guys, they're studying people, asking them questions, and finding out, how rational are they when it comes to money, uncertainty, and risk. And then the brain scientists are just watching how behavior happens. For instance, somebody's solving a math problem or making a decision about an investment, and all kinds of different parts of their brain are lighting up. Some that have to do with emotion, some that have to do with memory, and not just our frontal lobe where we think all the rational decision making is happening. All right, the final book is Predictably Irrational by Dan Ariely. He's a professor of neuroeconomics at MIT. These are must-read books for anybody exploring these fields of behavioral economics and finance. I just want to check my final notes. So I don't want to forget, Daniel Kahneman has a book from 2011, which I haven't gotten to yet, called Thinking Fast and Slow. So if you look up Kahneman and see the history of his work since the late 60s up till now, he's just been so focused on human decision making when facing, whether it's money or just any kind of uncertainty or risk. So Thinking Fast and Slow is his new book. And then actually one of his proteges, Richard Thaler, has also been, sort of carried on the legacy of what Kahneman started. And right now I've just started reading Thaler's Misbehaving. So I don't have a reference to that one here, but that's also an excellent book you want to pay attention to, where he's sort of recapping, what, because he's worked with Kahneman, what have they learned about human decision making in the past 30 years that could help us in our personal and professional lives, and hopefully in the stock market. And so, bringing all this together, I think we have two great opportunities to win in the markets from these two sciences. So we have behavioral finance on one side and neuroscience on the other. And the two great opportunities are, one, you can train your brain to become a better investor by understanding your own biases and then creating systems and rules to sort of outsmart your lizard brain. And then also watching the crowd, paying attention that the crowd in a given stock or in the market as a whole, we should expect them to move to irrational extremes, and then how we can take advantage of that. All right, I'll come back to this topic in a week or so. We'll go into more of the cognitive biases, and make sure you catch my podcast on iTunes, Mind Over Money. Thanks for joining me in the kitchen.